Trading in financial markets has always been an intriguing and potentially lucrative endeavor. However, as with any complex field, myths and misconceptions often circulate among traders, both novice and experienced. These myths can lead to misguided decisions and lost opportunities. In this video, we aim to debunk some of the most common trading myths, providing clarity and empowering traders with accurate information. Myth 1: Trading is a quick way to get rich. One of the most prevalent myths is that trading offers a shortcut to vast wealth and financial freedom. While it is true that successful traders can earn substantial profits, trading is far from a get-rich-quick scheme. In reality, trading requires careful analysis, strategic planning, and discipline. It takes time to develop the necessary skills and knowledge to navigate the markets successfully. Traders must be prepared for losses and have realistic expectations about potential returns. Myth 2: You need to win every trade. Contrary to popular belief, successful traders do not win every trade. The myth that traders need a 100% win rate can lead to excessive risk-taking and emotional decision-making. In reality, trading is about managing risk and maximizing profits over the long term. A trader's success is determined by the overall profitability of their trades, rather than the outcome of each individual trade. Skilled traders focus on maintaining a favorable risk-reward ratio and managing their losses effectively. Myth 3: Technical analysis is the holy grail. Technical analysis, the study of price patterns and market indicators, is a valuable tool for many traders. However, it is not infallible, as some myths suggest. Technical analysis provides insights into historical price movements and helps identify potential trading opportunities, but it cannot predict the future with certainty. Successful traders often combine technical analysis with fundamental analysis and market sentiment to make informed decisions. It's important to understand that no single approach guarantees consistent profits. Myth 4: Day trading is the only way to succeed. Day trading, the practice of opening and closing trades within a single trading day, has gained significant popularity in recent years. While it can be profitable for some traders, it is not the only path to success. Position trading, swing trading, and long-term investing are alternative strategies that can be equally rewarding. The choice of trading style should depend on an individual's risk tolerance, time commitment, and personal preferences. It's crucial to find a trading approach that aligns with one's goals and suits their lifestyle. Myth 5: Insider trading is commonplace. Insider trading, the illegal practice of trading on non-public information, is often sensationalized in movies and media. While insider trading does occur, it is not as rampant as some myths would suggest. Regulatory bodies and laws are in place to detect and prosecute insider trading activities. Most traders rely on publicly available information and analysis to make their investment decisions. It is essential to trade ethically and in compliance with the rules and regulations governing financial markets. Myth 6: Trading is gambling. Many people mistakenly equate trading with gambling, assuming that it is a game of chance or luck. However, trading is fundamentally different from gambling. While both involve risk-taking, trading is based on analysis, strategy, and knowledge. Traders employ various tools, such as technical and fundamental analysis, to make informed decisions. Successful traders use risk management techniques, set clear goals, and develop a trading plan. Unlike gambling, trading is a skill-based activity that can be improved with experience and education. Myth 7: You need a large amount of capital to start trading. Contrary to popular belief, you don't need a massive amount of capital to start trading. While having more capital can provide flexibility and potentially generate higher returns, it is not a prerequisite for entering the market. Many brokers offer the option to trade with smaller amounts of money, known as micro or mini accounts. These accounts allow traders to practice and gain experience without risking substantial capital. It's important to focus on proper risk management and gradually increase trading capital as profits accumulate. Myth 8: Trading requires constant monitoring. Another myth is that successful traders need to be glued to their screens all day, constantly monitoring the markets. While active monitoring may be necessary for some short-term trading strategies, it is not a requirement for all trading styles. Traders can employ various tools and techniques to automate certain aspects of their trading, such as setting stop-loss orders or using trailing stops. Additionally, long-term traders often make trading decisions based on higher time frames, requiring less frequent monitoring. It's important to find a trading style that suits one's schedule and lifestyle. Myth 9: Trading is only for professionals. Trading is often perceived as a field exclusively reserved for finance professionals or Wall Street experts. However, this myth couldn't be further from the truth. With the advancement of technology and the accessibility of online trading platforms, anyone with dedication and a willingness to learn can enter the world of trading. There are numerous educational resources available, including online courses, books, and tutorials, that can help individuals build a solid foundation in trading. Like any skill, trading can be developed and honed over time. Myth 10: Past performance guarantees future results. Traders often look at historical performance to inform their decisions. However, it is important to understand that past performance is not a guarantee of future results. Market conditions can change rapidly, and what has worked in the past may not necessarily work in the future. Traders need to adapt their strategies and remain flexible in response to evolving market dynamics. A comprehensive approach that incorporates both technical and fundamental analysis can help traders make more informed decisions.